All right, good evening, everyone. Welcome to the Hurley Investments Market View commentary for Tuesday the 17th. I need to apologize to you. There's no one here except for William. William, if I can, I'm going to unmute you so you can participate with us today. A lot of people want to hear your English accent, but I apologize. I had a bit of a, I don't know, the scheduling for GoToWebinar was not what I expected. Not that maybe I couldn't have sent one out quickly, but it just wasn't working out. So I'm going to do a recording for you, get this out. I've got William here, which has got to be the middle of the night out there in England. And I'm trying to unmute you. So if you can hear me, say something, please, so we can all hear you. I've got a couple things I want to go over, and I wish I could have it on a different day. And William just said he doesn't have a microphone. So here I'm trying to do something you're not able to do. My apologies. All right, let's just get started today. If you noticed, Baidu was down 6% today, which kind of is ridiculous because one of the things I was going to mention, or one of the things I felt I wanted to talk about, was just how important the opening of China is going to be. So let me just kind of throw this in there, that it is my belief that the reopening, you can't spell, opening of China has huge implications on the global markets. And here's just a couple thoughts. In fact, if I was to ask you, what happened when certain countries reopened after Christmas? I want to primarily say the US because I know the US best. I live here in the US. I know some of you are from Canada, and obviously Abraham, you're from Brazil. William, you're from England. So I've got a couple of you that are all over the world, right? What happened after COVID when it came to people, individuals, right? When it came to us? What did we do when COVID was over after a year and a half? For China, I kind of want to tell you it's only been 8 months. I could be wrong there. But what did we do as a people as we started to reopen? And William, you're going to type it in, so I already know. We spent, right? We spent. We got things we held off for a year and a half, or we weren't going to stores, we weren't buying things. We spent money. And this morning, I heard on CNBC, and I want to say it was, I don't know what the early morning was, but it's the one I was up at 5 o'clock this morning, which is 2.5 hours before the market opens. I heard on CNBC possibly as much as $2 trillion is available to be spent by the middle class in China. That's a huge amount. I might also say, and this is where I think it has a global effect, the reopening of the businesses sends more product internationally. So we basically have this opportunity to have the second largest economy in the world come back online. For me, I feel like that is an opportunity to jumpstart the US economy. Now, I also want to say in our favor, we have something. Man, I just can't type worth anything today. Something in relation to the market. And the market, I'm really talking about the S&P 500. And if I was to ask you, of course, no one's here, so I can't ask you. And well, I can ask William, right? If I can ask you, what do we have in relation to the market? Or another way to say it, is our market cheap? You guys could tell me the market valuation is in line or cheaper than it's been, and I'm just going to say for years, right? It's cheaper. It's cheaper than it's been for years. Now, the question is earnings, right? What it's really going to come down to, earnings will be king, and companies have to earn their earnings. And what I mean by that, I don't think it's going to fly, right? It won't fly to just buy back shares. You can't have so-and-so earnings, mediocre earnings, and then all of a sudden, going to make it big, right? You need to earn your earnings. You've got to have some decent earnings. You got to have earnings that are going to be fabulous. You got to have earnings that are going to surprise to the upside. I think I found it very interesting. Excuse me. The other day, there were some earnings for Bank of America and JP Morgan. In fact, let me get my information. It was last Friday. JP Morgan beat on the top line, 357 against 312. Beat on the bottom line, 34.547 billion versus 34.192. Top and bottom line beat, but they ended up being down a little bit on their earnings when they first came out. There was a negative sense to it. Was it because there was light volume on Friday? That's what I would have said, right? I would have said, well, there was pretty light volume. Big money was out. I could have put a lot of excuses why they were down, but look at the volume of retail trading on Friday. That was an awful arrow. Let me try that again. Look at the volume. Huge volume in Bank of America. And of course, today it's down. It did not hold the 50-day simple moving average. It is holding the 200. I'm sure if I was to put Bollinger Bands on here, let's see if I can put some Bollinger Bands on here. Let's see what that would look like. I bet they would be pinching. I bet they'd be pinching. Well, they're actually kind of widening. They pinched right up here. shocking. In fact, we're even on the top of their Bollinger Band level. I don't have an explanation for that. But that was Bank of America. In fact, I didn't tell you, Bank of America's earnings were 85 cents instead of 80. They came in at 24.5 billion instead of 24.283. Beat top and bottom. Bank of America. I was talking about JP Morgan earlier, which also opened up down. Look at that candle. Huge. Look at the volume. Well, Kevin, that's not so big as the loss or the volume at their earnings here. I understand. But the volume on a day before a 3-day weekend, that's huge. If it was just an everyday type of volume, no joke, we would have had 40. Would have been up here at 40 million shares. I just found it interesting. To make a long story short, I just found it interesting that it will come back down to stock picking, right? It's going to come back down to stock picking. We're going to have to find a way to have, I don't know, to have companies be top and bottom to be profitable. It's going to be a profitability type of push in the future. That's what I'm trying to say. The profitability will have to justify stocks moving forward and moving higher. They're going to have to make money. And the reason why I think that's so important for China, I think that benefits an Apple. I think that benefits a Bank of America for their overseas trading. That'll benefit Baidu because they're based out of China. It's a Chinese Google. Small businesses will do pretty well even in a recessionary environment because they've got pent-up demand. Disney will probably do really well. Disney will have some pent-up demand. It's that opportunity or that way of thinking that gives me just a glimmer of hope, would be the best way to say it, but the glimmer of hope or opportunity that I see in our stock markets possibly getting through a bit of a hard landing this first quarter. I could be wrong. I totally could be wrong. I could be dead wrong. But that's where the growth seems like it's going to come from as we still go through, and plain simple, we're going to go through 3 more rate hikes. And those 3 rate hikes, again, Squawk Box this morning, I guess I don't know what it really was, but the talk was 3 more rate hikes. Got to learn how to spell. Probably will be 50 basis points, but could be 3 quarter-point rate hikes. And again, I think if they only go a quarter point, you might really see, you might really just see our markets take off like no tomorrow. They might just, boy, they might really just shoot off like there's no tomorrow. Kevin, why would we do that? Basically because they're forward looking, right? If they're forward looking and things are starting to slow down, We still have to deal with the rate hikes that we have, right? But being forward looking makes it significantly cheaper for companies to be able to do business. If they're significantly cheaper for companies to do business, it leads to better earnings than expected. Another thought process, when I said market valuation, earnings estimates are way lower than expected. You want an example? Go look at Amazon. Go look at Google. They are ridiculously low compared to last year. It's scary how low their earnings are. I want to say like Amazon's went to $2.10 from, no, it's probably Google. Let's see if I can find where I was looking for that. Give me a second. Put you guys on pause. Give me a quick second. So I found my research tool. Let's look at Google. Let's see if I can find last year's. It was shocking. Give it a quick second. Look at the expectations, 15.3, 9.87, right? Look at where we're at right now. Look at the drop in the earnings potential that they're seeing in Google. Well, Kevin, why is that? Why do we have such a huge drop, right? Big drops down year over year. What's the expectation? Well, part of it is that you're going to see this big drop because the first thing to go is corporate advertising, marketing. Marketing budgets get cut significantly prior to a recession. It's the first thing that goes. It is really scary as you look at the drop in the expectations for earnings. Will it happen? No one knows, right? No one's going to be able to predict the future if it's going to happen or not, but it is definitely a little freaky with just how far some things are starting to fall and where they might end up relatively in just a short time frame, right? In just a short time frame, we could see some serious drops in earnings from companies that we used to know just knocked it out of the park, right? Amazon, Google, Meta, the FANG stocks. You might see some significantly tamer earnings coming from a Google, who in a recession would, probably not do as well. Amazon with razor thin margins. Meta, again, it's another advertising, right? Low advertising, probably not expecting a good quarter or two from Meta into a fear that we're going to have an inflationary excuse me, we're going to have a mild recession coming in the near future. Earnings. Apple's earnings change. They're on the 2nd. They're with Google and Amazon. The 2nd is going to be a really busy day in February for earnings. The briefing picture. I'm going to go just to this last little paragraph, which for the first time I maybe sound a little more interested or exciting for what we're going to run into. We are not starting 2003, and I'm actually just reading this last paragraph right here, so you guys know. We are not starting 2003 with an earnings multiple that is too high or too low. We are starting just above average in front of an earnings reporting period that is expected to be below average, with an economy that's expected to weaken noticeably, meaning multiple expansion and big gains this year won't be easy to achieve at the index level if the earnings guidance surprises are more negative than positive. That's a mouthful. The short answer is it's going to come down to earnings. And a mild recession, earnings would decline 1 to 10%. A hard landing would decline 10% or more from 2022. If we kind of put that into perspective, a mild recession means the first 6 months we're going to be flat. A hard landing means we're going to be down 10 to 20% in this first half of the year, but have the ability to make it up at the end of the year to be basically flat overall, but a good opportunity for collar trading. It's just something that I noticed. Definitely read through the briefing article because there's a lot more information in here. But the fact of the matter is we're probably slowed down with recessionary negative to flat GDP. If not, how do I say it? If not some more scares by the Fed of interest rate hikes. What's going to do good? You know, it should be a lot of what we're in. Again, Apple. I don't know if you paid attention. Because of Apple's stock performance, Cook, and I don't want to say via social media, but stockholders complained about Cook's wage, right? So Cook took a voluntary cut in pay. A voluntary cut in pay Cook took, but again, he's got hundreds of millions of dollars. It's basically ceremonial. It won't affect or help earnings at all for Apple, but he took a pay cut. Probably will end up being somewhere in that $40 million range. And Apple shares started to go up. Keep that in mind. Just keep that in mind as you're looking at what's happening. Markets are how they're going to end this week. I'm going to follow the trend. The last 2 weeks when I haven't really been with you guys, I guess it was here last week, I think we're going higher. Dow Jones Industrial Average is bullish. If we look at the S&P, it's just inching above the 200-day. Hasn't proven itself. Has not proven itself, but it is staying above for, 2 days now, above that 200-day simple moving average. With some of the earnings coming up, we stay above that. We're building a new base, and we're going to build a base between that 4,000 and 4,100 level, which might sustain us going into Q2 here, April through June. NASDAQ's above the 50. What a run off of 10,250, right? Hit it, bounced, moving. It's doing amazing and has some huge opportunities coming up above us. Okay, January, it's up like what, 1.5? We lost 0.2% today, 1.3. I've mentioned 4% down for January. I'm going to change that to being down 2%. And I might be positive here in the near future But today, Morgan Stanley and United Airlines after the market doing really well. Goldman Sachs, and I believe it was Interactive Brokers, horrible, right? Just absolutely horrible. Let me pull up Goldman Sachs on a chart just so you can take a peek at it. Look at that drop today. $24, 6.44% to the downside. That's why, as they spoke, that's what dragged all of the banks down today, except for Morgan Stanley. I'm going to do a little bit of research on the two, but it'll be interesting to see the difference there. Morgan Stanley up 6% while Goldman Sachs was down 6%. United Airlines, I don't know if it'll have the aftermarket. Doesn't have it. They reported their earnings aftermarket. I'll have to do a little bit of research to find exactly where they are at. But good earnings, did pretty good, and they were moving higher in the after hours. I don't have their numbers right now, so it's going to be interesting. It's going to be interesting if I go ahead and I pull up what we have left. Schwab tomorrow, Alcoa tomorrow, which starts on Wednesday, which starts the traditional earnings season. This weekend for the next 5 weeks, it's that 6-week period where historically it's like 84 or 86% of the S&P 500 earnings occur. Discover Financial Services, First Rise National, Fuller and Kimber Morgan is on Wednesday. Thursday, Fast Key, P&G, Netflix will be the big one there. Schlumberger on Friday. Economic reports. Tomorrow's huge. Tomorrow's super big, but really out of everything, the PPIs, the inflationary numbers, which should come down, will give us a bit of a boost. And then we also have the retail sales, where we will need to see a bit of a decent retail sales number to see an update tomorrow. Usually industrial production, cap utilization, business inventories, those are usually pretty important and pretty good. They usually will run, how do I say this? They will usually run the futures in the morning. Not important. It's really going to come down to PPI and retail sales. PPI to prove us that inflation's coming down. Retail sales to show that we can still have profits going into Q1 and Q2 of the year. Thursday, housing starts would be important, and obviously existing home sales on Friday. And for Friday, don't forget the monthly options expire. So it'll be a more volatile day. Looking to trade again, most stocks are with protection, getting ready for earnings. Nothing's changed there. I found an interesting article. Powell says the Fed might have to make unpopular decisions to stabilize prices. This is why when I heard this morning 3/4 point rate hikes, I kind of took a step back and I said, that doesn't make sense. That just, it doesn't resonate. It is possible, but it just doesn't resonate. And just to help you, I should have put this up here, just to help you know when to focus on this. Those 3 rate hikes, we have January/February, and they happen the 31st through the 1st. That'll be a Tuesday, Wednesday. We have March 21st to the 22nd, and we have May's, which are the 2nd through the 3rds. Those will be the 3 meetings where we should get rate hikes. and the expectation is June that we're going to slow down and stop. June, where it's like, hey, that's when they're looking to say they're going to back off. If they do and shoot to the upside and have three, how do you say it? You'd have three half a point rate hikes where they really are like, we've got to tame inflation. That kills it. That will have 2 negative GDP quarters. And regardless of what the political economists will say, 2 negative GDP quarters is a recession. Very interesting article, but this is where I would be leading to. Hey, we're probably going to have or be in a recession as we just run into the need for our Federal Market Open Committee to once again not get it right. They're like, well, who the heck are you to say that? I know, I'm just a stupid money manager. I get it. People asked us about Visa, about Square, about the financials with credit risk going into a recessionary environment. Here's a perfect example. Some consumers are financed holiday spending with record amounts of debt. The credit card is in play. So if the credit card is back in play, your expectation should be that we're looking at some type of opportunity is all I'm going to say. We should have some type of opportunity that give us the ability to be able to take advantage of consumer debt, right? And that should come in the way where Square, where Visa, where some of these credit cards, where some of the credit companies like Ford can take advantage of the debt that people are in without having to worry about putting all its money aside for failed debt. And I'm probably not saying that right, but where they set aside cash for I can't remember the word I'm trying to look for. It's in the tip of my tongue, but plain and simple, people seem to be okay and have the ability to finance their debt right now, which means, again, some of these companies that are holding consumer debt should be okay. We can take advantage of it with some of the companies that we're in. I found this article really interesting. It was given to me by Bill. There's been a bad sign for stocks historically when there's a gap between how companies and government measure profits. This is just like us paying taxes, is the best way for me to say this, right? How often do we tell people, hey, I make 100 grand a year, right? But when it comes to taxes, we might make 100 grand, but we get business write-offs, we get tax write-offs, children, dependents, mortgage insurance. So we make 100, right? But in reality, we're getting taxed on 60. That's the same gap between how companies and how government measure their profits. Companies are always on the high side. Our revenue was 100 million. Government, though, hey, our cash flow, our net income, our after expenses, are 50 million. They look at it two different ways. It's an interesting article. I disagree with it, but I'm putting both sides of the story here. It's not that important. I don't see the correlation, but just because companies talk about their income the same way we do does not mean that we're in trouble or there's a big problem coming up. It just means that they talk about their revenue they bring in versus taxable income. And I don't think we're in any worry here, but I did want to give it to you so you could see both sides of what I was looking at. I have Baidu. Should you hold on to it in the morning? Again, another article that says Baidu is a deal, a steal of a deal. With that said, when you lose 6 months in a 6 months, 6% in a day, it's scary. Today we had a fund churning out of Baidu, fell from 139 all the way down to 130, but it did hold 130 today. So we'll see how it goes forward. Yes, we did already have our puts in place. The stock market rally looks unsustainable as the S&P 500 enters a newer valuation regime, warns Citi. This is another pretty interesting article that you guys should read about those valuations. The market is cheap, comparatively speaking, but we're not out of the woods. That is the best way to explain where we're at and why. So hopefully we're going to have some good articles for you guys to read. Last one, JP Morgan tops estimates for fourth quarter, but says mild recession is now the central case. Yes, we'll probably go through a quarter, if not two, just like we did last year. And profits are going to come on the back end of the year with no more interest rates. So we're going to have some certainty. I think we've told you a million times, right? The markets love certainty. All right, William, if you have any questions, type it in. But guys, I will look forward to seeing you on Monday. I apologize for my scheduling that made this a bit of a problem. If you do have any questions, just email me, khurley@hurleyinvestments.com, or you can go to info, that'll get to me. But obviously no one's here and William doesn't look like you have any questions. Guys, have a wonderful evening. I'll get this posted. I'll kind of push Dave Westlake to get this posted as quickly as possible. It's actually David W. And we're going to go from there. Talk to you guys later. Have a good evening, and I look forward to seeing you guys next week. Bye-bye.